What's up, everyone? It's Karthik with MoneyVest. So markets selling off very aggressively last week, as we have already done an update on this, but I wanted to do another update going over what Tom Lee said towards the session lows, towards the market close on Friday, and then also going over some other recession indicators, both for and against, and also help you prepare for what could be not a great next few weeks in the markets and also in the economy, and how to approach from a personal finance standpoint as well. So make sure that you share this video with your friends and family members. I think it's going to be very, very helpful, very useful. Even if they're not investing, I think it's going to be very important for them to prepare for a potential recession in the US. And also drop a like and subscribe to the channel and check out the links down below if you're interested in joining us. So this right here was the interview from Tom Lee and Scott at CNBC, and these are my notes as to what he exactly said. Obviously, he mentioned that this has been a rough week for the markets. First September week, we are down about 4%. September historically has been a very, very bad month for stocks, as we've already discussed from a seasonality perspective. And this particular September was the fifth worst September since 1929. So it just goes to show how brutal the selling pressure was. And he also mentioned in a tweet and in that interview, there's not been a lot of fundamental reasons as to why stocks are selling off. That is exactly what I also mentioned in the live stream, right? We don't really need a reason for markets to sell off. Although if you really were looking for a reason, you can come up with the carry trade, right? So dollar index depreciating against the Japanese yen. We've got the spread between the 10-year treasuries and the Japanese 10-year bond also diminishing. So that spread is coming down. Dollar index is depreciating against the Japanese yen, and that's also creating a little bit of that blow up of the unwinding of the carry trade, as well as some political reasons, as the polls once again are suggesting for a Trump win, which is going to create some more restrictions with China, which is not going to be great news for stocks like Nvidia, AMD, so semiconductors and chips, and they're the ones that are kind of leading this market sell-off. So again, if you were really looking for reasons, those could be potential reasons, and the markets are also becoming a little bit more defensive. Heck, not even a little bit, a lot more defensive, as we have discussed this in our previous updates, as utilities is the one that's actually leading the markets right now. And we've talked about the performance in the last 2 months, 3 months, and even year to date. Technology is nowhere near close to the top 5 in terms of year-to-date gains. I mean, they're the ones that actually are lagging pretty significantly, and it's really utilities, financials, industrials, staples that are actually the ones that are leading this market higher. So if you were out there looking for reasons, those are your bullet points, but let's come back to what Tom Lee mentioned. So historically, this has been a tough time for stocks, and markets are going risk-off early, because as we know that it's towards the back half of September going into October when the selling pressure really accelerates. But right now we're seeing that pull forward on that correction. So the markets are front loading that sell off right now. And we're at a point where the Federal Reserve could engineer a soft landing because the jobs report was still strong. However, there's both for and against a soft landing scenario, which I'll go over later in the video, because there's definitely a specific signals that have 100% probability of essentially indicating a recession, which are now firing off, which I think is really important for everyone to understand how they're calculated and why they're so important. Now, it depends on how the market interprets the rate cut. So as we know that within 12 days, next couple of weeks, we're going to get a rate cut, the first rate cut in over 2 years from the Federal Reserve. And Tom Lee mentioned, which I think was very interesting, is how the markets interprets that rate cut. Are we going to get a 25 or a 50? But then within that 25 or 50, is the market going to view that as a dovish or a hawkish or a panic, right? Because if we get a 50 basis point rate cut, and then, with that, we get an accompanying press conference from the Federal Reserve, Chairman Jerome Powell, that, we're kind of seeing a lot of indicators that are showing serious weakness in the economy, and that warrants us to do a 50 basis points rate cut. I think that's going to come off as very, very panicky, which the markets are not going to like very much, because I've got a chart in the next slide that's going to show you a fast cutting versus a slow cutting cycle in the market. And when we see a fast cutting cycle, right, when the Federal Reserve is cutting interest rates too fast or too aggressively, that's also not good news, because then the market starts sensing a potential recession, right? The Federal Reserve obviously has more access to data, and if their lead time is, look, we're expecting a recession and let's just cut rates fairly quickly to normalize the overall economy, well, the market's going to sense that, and they're going to start selling off pretty aggressively in anticipation of that recession. If you get a 25 basis point, I think that's pretty much a done deal. 70% probability that we're going to get a 25 basis point cut. But then again, what is going to be the accompanying press conference? What is going to be that speech from Chairman Jerome Powell? dovish, hawkish, a little bit more panicky or more calm, right? What's going to be that tone and that language, I think is going to be very, very important. So, but either way, Tom Lee says that it's good news that the Federal Reserve is cutting interest rates because that's going to drive more liquidity into the economy. And tech revealed its hand last week with NVIDIA's earnings. And another thing that I think is very interesting, when stocks fall on good news, there is actual bearish sentiment. There's actual weakness in the market because it could have been a crowded trade or significant profit taking, as we have discussed in our previous updates. And the markets are pulling forward on that seasonality because usually we tend to see the back half of the month, which is really brutal. But right now we're already seeing significant selling pressure and investors want to de-risk. And there could also be political reasons. And he also mentioned that we did expect a 7 to 10% drawdown in the markets, which I covered earlier in the week. I think there was an interview on Tuesday, which I broke down in my other updates, and we're already at 5% now. So 5%, already from this entire week sell-off, and we could pull forward on the entire correction. And they said that they're not a seller here, but they're going to wait and see how the markets stabilize, when and where the selling pressure gets exhausted before they start scooping shares at those discounted prices. So that's the overall general breakdown of what Tom Lee mentioned during that interview. But this right here is the S&P 500's performance 6 months before and 12 months after the first Federal Reserve rate cut. And this is from All-Star Charts, essentially suggesting for a fast cycle versus a slow cycle. And this is so critical. Like, this is actually a very, very good chart, put together by them, because this essentially gives us a bit of an idea of how the market tends to interpret the rate cut. Slow cycle is 25, 25, 25, more calm and more stable. A fast cycle is 50, 75, a more of a jumbo cut, right? Because they are anticipating a recession. So that can create a little bit more of a panic in the market versus a slow cycle, which is more stable and more steady. And you'll notice that most of the times, pretty much every single time you've seen a slow cycle of rate cuts, markets have been higher 12 months after the rate cut. Versus when we have gone through a fast cycle, the market has anticipated, or they've kind of, forward-looking wise, they've already predicted a recession, and that has resulted in the market's performance being really, really bad, right? So we've come down in a fast cycle rate cut versus a slow cycle rate cut. So what we're really looking for is more insight in the next couple of weeks from the Federal Reserve, and what is that rate cut going to look like, and accompanying what that press conference is going to look like from the Federal Reserve and, of course, Chairman Jerome Powell. Now, when it comes to valuations, we have already come down. So S&P 500 is trading at just a little bit over 20. NASDAQ is still above 25, and Russell 2000 over 23, almost 24, and the Dow is over 18.4. Almost all of them, every single one of them, except for the Russell, is trading above their 10-year average. Russell is about on par with its 10-year average valuation right now. This has been September for the last 3 or 4 years, I should say. So over here, this right here is 2022, this is 2023, and this is where we are for 2024. Are we going to see another September sell-off? It sure looks like it. We're down over 4% already in the first trading week of September. However, I've also pointed to the idea that October is a month which is usually bottomed, right? So again, if you come back to the green arrows, you'll notice October, very nice rally after the sell-off. October, a little bit of a mini rally over here before the 2022 bear market. October over here, very nice rally here. And this right here, also October, very nice rally back up. So there is a silver lining that I really want to help you understand, that while September is a brutal month, while there is selling pressure, if you combine it with October seasonality, it tends to form a bottom in the markets and usually tends to be a very, very good buying opportunity. So if you do continue to basically see a sell-off, October, November, December, the probability is really high for us to close out very strong. And of course, we've got other catalysts to also account for. Recession, for example, earnings season is going to be starting very soon, and all of that is going to be playing a very, very big role, as well as the interest rate cutting cycle from the Federal Reserve. Now, we've also talked about the September seasonality with volatility, so combining both of those numbers together. The last 4 years, again, not so great, with an average and median sell-off of about 5.7%. So 5.7 to as much as 4.8% last 4 years. And we're already there. The first week, it's kind of like a done deal. Of course, we could still see a bigger sell-off because in 2022, we essentially witnessed a 9.3% sell-off for the S&P 500. We're down 4% so far. It's kind of on par with last year and 2021 and 2020, and also the median and the average values. It's a little bit more compared to the average red days. We're literally right there, right? Median and average, 4.3, right? This is accounting for all the last 13 years. And so far this year, in the month of September, the markets are down 4.2, right? So this is the sell-off. This is the red candle for S&P 500 for the first week of September, and we're down 4.25, which is quite literally on par with the average red years and the median red years. However, the last 4 years is a little bit more, so we can expect the markets to accelerate a little bit further going into next week. We've got inflation, and again, the Jerome Powell press conference and the FOMC meeting in the next 2 weeks, so in about 12 days. So there is possibility for us to see some acceleration to the downside. There's some support levels that I will highlight, but we are very much well within those ranges where we have seen the markets sell off in the month of September. Volatility is also in that range. So right now, I would put it very, very comfortably to a point where what we expected from the markets in September has exactly happened in the month of September. We expected volatility to be with an average or median value of 20 to 25. We're at 22. S&P 500 to expect a 4 to 5% sell-off. We're at 4.3% drawdown. So we are well within those expectations from the markets, and it's playing out exactly what historical data suggested for us. Now, coming over to this report, the jobs report, right? So this were some of the gains and the losses, majority of those gains coming from the leisure and hospitality sector, private education and health services, and government jobs. We did see a pretty significant sell-off in manufacturing, as I mentioned in my previous updates, and then also retail trade, about 11,000. And then we also had information technology down about 7,000. Now, this was a report, and this is the monthly changes in non-farm payrolls, and you'll continue to witness, some higher readings, a little bit of lower readings, and then even lower readings. So this is lower highs for non-farm payrolls if you want to apply a little bit of technical verbiage, but this is just the lower highs that we're witnessing. So fewer and fewer job additions each month. That's a sign of weakness in the labor market. Now, this is what's interesting with a 100% track record of predicting recessions with no false positives. So this was an indicator that was created on Mishtalk, and this is the McKelvey recession indicator combined with job vacancies. So Edward McKelvey, is an economist at Goldman Sachs who created this indicator originally, which is essentially taking into account the 3-month unemployment rate. So the unemployment rate, the 3-month average unemployment rate, and then subtracting it with the 12-month low, right? So if that difference for the 3-month average unemployment rate minus the 12-month low is 0.3 percentage points or more, so if it's 0.3% or more, then a recession has started. That's the Edward McKelvey recession indicator. Now, Claudia Sam, as you've already heard in many financial media platforms, the SAM rule of 50, essentially took that indicator, who's a Fed economist, and revised the rule, and again, claiming it as her own without giving credit to McKelvey, and then set the indicator to 0.5. So instead of 0.3 reading, we set it to 0.5, and then we've got the SAM rule. Now, what this Mishtalk, and this is the unemployment rate, that's all they're accounting for in this indicator, recession indicator of unemployment. The 3-month average minus the 12-month low is above 0.3 or 0.5, then we're in a recession. But there's a lot of false positives with this type of analysis. So what they did, Mishtalk, basically took PMES second indicator. So they actually created another recession indicator after combining job vacancy rates with the unemployment data. So not only are we looking at unemployment rate, but we're also looking at job vacancies. And the way we're calculating it is the difference between the 3-month trailing average of unemployment rate and the minus 12-month low, plus the difference between the 3-month trailing average of the job vacancy rate and its maximum over the past 12 months. So not only are we accounting for unemployment, 3-month average minus 12-month low, versus also the job vacancies, 3-month average and the maximum over a 12-month period. And this is what you get. This is what's combining those two indicators together, unemployment and job opening or job vacancies. And you get an indicator that looks like this, a modified McKelvey recession indicator with no false positives or false negatives since 1953, suggesting for the fact that we're already in a recession now because it's now at 0.54. And you can set those trigger readings yourself, and this is all going back to 1953. Every time we've been above these certain levels, we've been in a recession, or recession's been right around the corner. We've seen a recession start sooner or later, and that's where we are once again right now. I guess 2021 or 2020 may have been one false positive, but in that article, they essentially said, I propose a trigger value of zero point 0.4 or a write-off of the October 2023 value that barely touched 0.3, that did not exceed 0.3 for another 6 months. And right now, as it stands, we are 0.54 in the month of August with a lead time when it has been negative. That means the negative meaning that there's been a delay in the recession by about 3 months. An average of 2 to 3 months has been that number. So 2 to 3 months from here, we're talking towards the end of 2024, early 2025. And there's been a lot of other indicators, as we have already pointed out in even my other spreadsheets like this, that you'll suggest that, we've got a lead time of anywhere from 2 to as much as 5 months for a recession in the US. And this right here is that these are very impressive numbers versus SAM at 0.5, which has at least one false positive and lag times of greater than 7 months. Combining these triggers eliminates the false positives and negatives and allows the use of a lower trigger, 0.3 or 0.4. And I know that since 1953, every time the economy was in the current state as it is right now, as 0.54, with this indicator, the economy was in recession. So that obviously is not good news because 100% probability, and then they also mentioned that that does not make the odds 100% because everything is up to the NBER, that's the National Bureau of Economic Research, the official arbiter of recessions. They're the ones that are going to officially call whether we are in a recession or not. But these are some of the indicators to keep in mind that yes, unemployment is worsening, job vacancies are worsening. We're seeing that equilibrium for job openings versus unemployed persons coming down to as low as 1. So, whether we see a recession or not, of course, we'll find out very soon. But I really want everyone to follow this liquidity framework because I think it's really going to help you in times of recession where you've got specific months of expenses saved up. I did a video on this specifically a few weeks ago, and where I like to personally operate is somewhere between sufficient, secure, or robust, meaning that I've got 6 to as much as 24 months of expenses saved up in liquid cash, right? It's going to be a money market funds or a high yield savings account where if I lose my job, if something were to happen, if there's an emergency or a health problem, whatever it is, at least I've got the cash to cover for it, right? That's going to put me in a sufficient, secure, and robust position. So this is nothing but telling you the liquidity level that you're in and how many months worth of expenses you've got saved up in your savings account. And then this right here is the liquidity level for the percentage of cash that you have in your brokerage platform, right? So if you're a long-term investor, this is where you ideally want to operate, somewhere between defensive and prepared. So that's where I like to be, somewhere between defensive and prepared. Very, very rarely would I get up to over opportunistic, and that's only getting down to the lower band at 30% cash in my portfolio for future opportunities, for future sell-offs. But somewhere you want to be 10 to 20% to as much as 30%. That's really where you want to be because that's going to put you in a defensive/prepared situation with your liquidity with respect to the portfolio. And again, you can take advantage of those market opportunities when markets are selling off. You certainly don't want to be distressed, meaning that you've got less than 0% cash, meaning that you're borrowing money to invest in stocks and you're taking on margin because, one big sell-off in the markets and it's going to blow up your account. So you certainly don't want to be there, but you also don't want to be underinvested where you're sitting on over 60, 70, 80, 90% cash because then you could miss out on a lot of opportunities in the market, right? Because again, we're not trying to time the market here. We're just trying to play around with our cash exposure a little bit so that we can be prepared or be a little bit more defensive. And there's nothing wrong with that, right? Warren Buffett selling stock to raise cash, billions of dollars, hundreds of billions of dollars in cash, waiting for better and better opportunities while also earning a nice little yield on his cash. So there's nothing wrong with that. Do the more reasonable thing, the less rational thing. I think it's really important to remember that. Now, this right here is where we are with the federal funds rate and 70% pretty much locked in for a 25 basis points, but the expectations have really, really come down. And we're now expecting about, 1, 3, 5, 6, 7, 8, 9, 10. About a total of 10 rate cuts is what the markets are pricing in now between now all the way through 2025. That is a lot of rate cuts. If you combine that we're looking at 250 basis points or 2.5% worth of rate cuts with the terminal rate for the market now at 2.75 to as much as 3% is what the markets are pricing in by September of 2025. Of course, these expectations will change over time. And this right here is also showing us the recession lead time from the uninversion of the yield curve. So with respect to the yield curve, so now avoiding the unemployment rate, but looking at the yield curve, the number of days it's taken us to get to a recession is 66, which is again just a little bit over 2 months 2 months because the inversion happened in 2022 and the uninversion happened more recently. So in the last couple of days, we've seen the uninversion take place. And now that's about a 66 days worth of lead time for the recession to begin. However, there's also others suggesting for a soft landing. So this is Campbell Harvey, professor at Duke University. Can we pull off a soft landing? I believe the answer is yes. The main impediment is the Fed. They overshot with rates and have held rates at a level far too high for far too long. And the Fed's actions have increased the probability of a hard landing, but I'm still betting on a soft landing. I recently mentioned the striking similarity between 2007 and 2024 on August 7th, 2007. And just see if it sounds very similar to you. The Fed held rates at 5.25%, noting concerns with inflation. The yield curve had been inverted for 19 months. And indeed, you could easily change the date to July 31st, 2024, and the statements would still be accurate. Interest rates well over 5.25%, concerns over inflation, inversion of the yield curve well over 780 days, and that's exactly what happened back in August of 2007. So he does put together some cases against a hard landing, soft landing versus hard landing, strong housing, equity versus debt. So households continue to be in a very good position. However, I would argue that there is rising debt levels. Unemployment is rising, rate is low, and still plenty of job openings. However, this right here is a potential a weakness in the economy, which is now trending in the wrong direction. Real-time inflation is less than 2%. Yield curve inversion gave companies time to strengthen their balance sheets. So I would definitely give a plus point here because companies are in a much better position now than they were a few years ago. They've got more cash on the balance sheet. Big banks have low leverage due to higher regulations, and U.S. relatively immune to geopolitics. AI revolution will benefit the U.S. So there's definitely reasons for a soft landing. However, reasons for a hard landing: Fed has kept rates for far too long, decreasing future growth and increasing uncertainty. Yield curve inversion with the SAM rule and another rule that I just showed you guys. Consumer savings have depleted. $9 trillion deficits over 5 years has reduced flexibility. 36% of income goes to pay interest. And then, of course, office, commercial real estate, regional banks, all not in the best situation right now. So I'm kind of leaning a little bit more towards a recession. Not that I want to sound bearish or sound the alarm of a recession. I think there's a lot of indicators that are now trending in the wrong direction. So it's kind of like this. The indicators that were showing strength are now trending towards weakness versus the indicators that were already pretty bad are not trending in the opposite positive direction. Instead, they're just only getting worse. So $9 trillion deficits. Again, we're going to have more deficits this year. Then we've got more interest payments. Office, commercial real estate continues to be in a very, very bad spot, with regional banks, also smaller banks, not doing super well on their balance sheet as interest rates, again, stay relatively high. We've got unrealized losses, pretty big losses on their loan books. And again, the yield curve uninversion is actually a worse indicator than the inversion itself. And then again, some of the other indicators related to unemployment. So the good indicators are trending towards being bad indicators, and the bad ones are already bad. They're not trending back to good. So those are some of the reasons why I do believe there is higher probability for a potential recession. And what does really well in recession? It's utilities, it's staples, it's defensive, and that's exactly what's happened, right? Something that we have discussed in our previous video. So if you come over to XLK divided by XLU, again, this is a chart that I've mentioned over and over again, where technology continues to underperform relative to utilities. So utilities is really where the markets want to be. And according to Goldman Sachs, utilities is also a sector that they've put overweight. And it's actually doing much better, of course, on a year-to-date basis, something that we have also discussed in our previous videos. So utilities and staples, two sectors that they have put down as overweight because that's where investors flock to find safety. And even the bond market. So this is just one of the charts for technology versus utilities. But if you come over to SPY over TLT, equities over bonds, again, you'll notice the underperformance that's in full swing. It's been coming off, from 6.1 down to now 5.4, 10.6% underperformance in equities relative to the bond market. So that's really where the markets are going to be right now as global liquidity index continues on its way up, and we're seeing significant increase at the moment. So hope you all enjoyed this video and a complete update on the markets. Let me know your thoughts down in the comment section below, but I really want all of you to be prepared for a potential recession. Follow this liquidity framework because I think it's going to be very useful. So share this video with your friends and family, other investors, traders that can benefit from all the value of this video here. And make sure that you drop a like, subscribe to the channel, and links to our Discord and Patreon is going to be down below. We'd love to have you on board. As always, happy investing. I'll see you all in the next video.